Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing the Chef's Warehouse stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a small cap company, 1.5 billion market cap. They're trading at $37 a share and they have 41 million shares outstanding. The Chef's Warehouse distributes specialty food products such as artisan charcuterie, cheeses, oils, vinegars, truffles, caviar, chocolate, pastries, beef, seafood, poultry, cooking oils, butter, eggs, milk, and flour. They sell to restaurants, fine dining establishments, country clubs, hotels, caterers, culinary schools, bakeries, chocolatiers, cruise lines, casinos, and specialty food stores. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have negative free cash flow in 21 and 22, a small positive in 23. Then it grew 900%. You heard that right, 900% to 44 million in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. They finally turned a profit in 22 and they kept it going. It grew to 35 million in 23, 41 million in the trailing 12 months. This is what you want to see when you invest in a company. Each year is better than the last. Revenue is the sales for the company, and that almost exactly doubled from 1.7 billion to 3.7 billion. Really nice growth year after year. They seem to be hitting their stride. We estimated 4 years of future free cash flows. We also estimated a terminal value with all cash flows past year 4, that's 2.4 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2 billion. We divide that by 41 million shares, and we get a calculated stock price of $49. They're trading at $37, so they're trading at a 26% discount. It's a buy according to the model. Let me know what you think. Do you think it's a buy or sell? Leave a comment. There are 14 companies in the same industry as Chef, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. Well, they are the median in terms of CapEx, 67 million. Which seems odd because there's an even number of companies. How could they be the median? The median will be the average of the middle two companies. So for example, the median for these three numbers is 2 because it's the middle. But the median for this group of numbers is 2.5. 5 divided by 2 because you take the middle 2, the average of the middle 2. Debt to equity ratio doesn't look so good. It's 2. For every dollar of equity, they have $2 of debt. They don't pay a dividend. 44 million of free cash flow. Well, it is positive. That's good. Their cash flow is better than the next 9 companies, although the top 4 are much better than Chef. Chef and Anderson's market cap is really, really close. Yet Anderson's free cash flow is like 12x Chef's. Chef ranks 5th in market cap. All their price multiples are worse than the median, so this may imply they're overvalued. I don't rely too heavily on price multiples. I do look at them, but there's a lot more to look at than just price multiples. They have 3.7 billion of revenue. Look at United Natural, 30 billion. That's a lot of revenue. And Chef is still growing. Their 5-year annual revenue growth rate is 19%, higher than the median average. Here's their latest income statement. Revenue looks decent, up from 880 million to 950 million. Cost of revenue 725 million. Gross profit, 229 million, up about 10% from last year. SG&A is also up. That's their biggest expense, outside of cost of revenue, of course. 190 million. Operating income, 34 million. They spent 11 million of interest on their debt, a little less than last year. Most companies are spending more than last year because interest rates are getting higher. I guess they shed some of their debt. Net income grew a lot, under 10 million to over 15 million. It grew more than 50%. EPS is 41 cents, up from 26 cents. And they are adding some shares, not much, but some shares, 37.6 million to 37.9 million. About 290,000 shares were added. So to summarize, I have them trading at a 26% discount. My prediction is close to 50. They're at 36.50. I rank them 7 out of 10. Would I buy? 5 out of 10? Because even though my model says undervalued, I think there's going to be a pullback because I think it ran up too quickly. And people generally take in their profits. And you can see their price multiples reflect that. Their ratios aren't that great, 4 out of 10. Financials look real good because they finally have positive free cash flow. That's a huge milestone for a company. Also, revenue more than doubled since 2021, so they're moving in the right direction. Of course, they don't pay a dividend, but I can see in a year or two them starting to pay a dividend. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.